Hello everyone, I've got 3 high quality financial companies to share with you today that are perfect for your watch list. Financial stocks make up the backbone of many super investors' portfolios and can offer amazing returns with security from make or break tech stocks that rely on innovation and high development costs. These companies that I've picked out in particular have proven business strategies that are held by hedge fund managers all over the world. So I'll be going through these strategies today, their financials, and finally talk about their valuations right now. And if you get something out of this content, then feel free to subscribe to the channel and maybe like the video. Kicking it off with the first company, we have Fair Isaac Corporation, or FICO, which is a software company focused on a credit scoring service, returning a huge capital gain over 350% in the past 5 years. FICO has been doing very well, being held by the London super investor Nick Train, where it accounts for over 13% of his portfolio. Now, this company tries to predict how safe it is to lend different people money and how likely they are to pay back the loan in time. This prediction takes the form of a FICO credit score. Now, this credit score is used by businesses to decide whether to give you the loan in the first place, with the likes of mortgages and credit cards. So this company has effectively created its own metric of unit to measure credit, and it shares the company name FICO. This has become the fixture for consumer lending in the United States, which means that this company, with its fast-growing FICO platform, which grew its annual recurring revenue by 53% in 2023, offers a unique, monopolistic and predictable runway for growth. This is demonstrated in the company's financials. They've got a top-line revenue growth rate increasing at a 9% CAGR over the past 5 years to $1.5 billion, and an operating cash flow growth rate CAGR of 15% over the past 5 years to $479 million. Now, while those numbers may appear low in terms of growth on top-line revenue, you can see the consistency this company offers each and every quarter by quarter, going up. Now, this one does hold a significant amount of debt at $1.8 billion and has been trending up in the past 3 and 5 years. But they could pay this back in just over 2 years if they wanted to. Now, the big appeal for this company is the share buybacks they are conducting. They've been aggressively buying back their shares, holding 34.9 million shares in 2014 and now having just 25.4 million outstanding in 2024. This increases the value of shareholders' investments and has increased the return on invested capital to over 50% in the past years, which is a huge level of return that isn't offered by that many companies. In terms of its valuation, this one has always been very expensive, with a lot of that predictable growth priced in. The current cash flow yield as the share price sits is just over 1.3%, which is a tiny amount, the lowest yield in the past 2 years actually. Similarly, the price to operating cash flow is extremely high at 70 times operating cash flow, which is just a massive amount. And for comparison, Visa's price to operating cash flow sits at 26 times operating cash flow. So to me, this one is very highly priced, past what I would consider myself. But the reasons it's on my watch list, and maybe one for you to consider, is because just 2 years ago, these metrics were signalling a much better buy price and valuation for FICO. In September 2022, it offered a free cash flow yield of over 4% and a price to operating cash flow around 20 times. So it has gone on dips in the past, and from looking at the share price, we can see it's up over 392% in the past 5 years, outperforming the S&P 500 and returning great returns for investors that invested at the right price at the right time. Now, the next stock is MasterCard, the payment network provider that operates its duopoly with Visa in the credit card and debit card space. This is another one that's held by super investors, making up significant weighting in Valley Forge Capital's portfolio at close to 20%, and Pollen Capital having 5% of their portfolio in this particular company. This payment processing company charges a small amount of money to the merchant for maintaining the network to process the transaction. MasterCard processed 18 billion credit card transactions in Q2 of this year, meaning they gain billions in revenue from charging a small admin or administration fee of just 0.15% per transaction. They are simply moving data from one place to another in the form of money, and then charging an assessment fee to do so. This has led to an excellent top-line revenue growth rate CAGR over the past 3 years of 18% to $25.7 billion. MasterCard and Visa operate in the space where they have done the hard work of establishing their cards and brand throughout issuing banks, so they simply have to maintain their own dominance and network, which they are doing by using their high operating margins to produce record amounts of free cash flow, producing £10.6 billion in 2024, growing at a 20% year-over-year CAGR for the past 3 years. This high amount of free cash flow allows the company to buy back its shares at a nice rate, around 2% per year, and they've been growing that dividend in a double-digit percentile range to $2.64 per share, which is a massive green flag for any company and looks likely to continue in the future. For a valuation at the current share price, it offers a free cash flow yield that is just over 2.5% and a near 40 price to free cash flow, which are both close to the average for this company in the past 2 years. But looking at this metrics, I'd say it's slightly overvalued right now, but tends to be valued at high multiples and has quite a bit higher than what is offered by its counterpart company Visa. However, it may be one for the watchlist, as in the past it has traded at much better valuations. Then we get to our final stock, which is a historically successful business embedded in the financial ratings industry, and that's Moody's. This one is owned by the likes of Warren Buffett and Valley Forge Capital Management, with it making over 13% of their portfolio. In effect, Moody's gives a credit rating to companies, governments and securities, which is completely unavoidable for most institutions after a certain point in size. Additionally, they run an analytics business that helps assess risk and carry out economic research for companies. Moody's, along with S&P Global and Fitch, dominate the ratings business. This has led to very good share price appreciation, with year-to-date returns sitting at 25%. And this has passed on to their financials, with their top-line growth in revenue, which is growing at a consistent 7% CAGR in the past 5 years to $6.2 billion, which, due to excellent margins, is translated to around $2 billion in free cash flow, growing at about a 9% CAGR over the past 5 years. They have very little debt and boast a dividend that is growing in a double-digit percentile range over the years to $3.40 per share. Then we come to the valuation for Moody's, which sits at a free cash flow yield of 2.6% and a 38 times price to free cash flow, which is not historically that high for this company and sits around fair value or slight overvaluation. Now, this is still a high multiple of free cash flow for a company only growing its revenue 7% year over year. However, its yield in free cash flow has spiked over 3% in the past 2 years, with a multiple that has gone below 30 times free cash flow. So I'll keep it on my watch list and take a look when it gets closer to those levels. Well, that's about it, guys. All of these stocks are on my watch list and have been bought by super investors in the past or are still being held by them today. Now, time will tell if they return to levels that I would be more comfortable with buying them for, but that's the reason to have them on the watch list. Let me know what you guys think of these stocks down below, and as always, catch you guys in the next one.